Welcome back. This is Dr. Moore again of efficientminds.com. We are working our way through this presentation of my notes from the Global Asset Management Education Forum 4 in New York, March of 2014. We're now on the alternative asset section. In case you were wondering how we got here, we started off on my website, efficientminds.com, hovered over seminars, work our way down here to Game 4 conference notes. We click there. We make this full screen. We get rid of this little banner, and we have been working our way through. So I think this hyperlink will work. Yes. So here we are in the alternative assets versus equities. We're going to look at why, some examples, and some other information here. All right. So why do we need alternative assets? Alternative in the sense of something other than stocks and bonds. Well, during the 80s and 90s, the correlation, and this little row here is the correlation coefficient, which students in my class should be well aware of. But the correlation between stocks and bonds has been positive, and we know from portfolio theory, when two assets are positively correlated, the higher the correlation, the less beneficial the diversification, or less diversification there will be. However, 7 or 8 years ago, now I have a little note here, I think the presenter meant the past 7 or 8 years, correlations between stocks and bonds has been negative, and the correlation between stocks and alternative assets has been greater than zero. So I'm pretty sure this was the last 7 or 8 years. Hopefully somebody will watch this one day and confirm or deny that. Stocks and bonds have been negatively correlated, which makes sense on why that old 60-40, 60% stocks, 40% bonds is kind of a standard recommendation of what to do with your portfolio, because when one goes up or when one goes down, the other one's going up, and it kind of balances out. The hedge funds haven't been done so well the last 7 or 8 years. I don't know how they did last year, but when the market was going down, they went down big too. So if they're positively correlated and have a much higher beta, they being alternative assets, high beta, positively correlated with the stock market, from 2009 onward, that wouldn't paint a pretty picture for alternative assets. So now this was an interesting time frame. I hope I don't know if I meant 2014 here or not, but correlation between stocks and commodities was zero, but commodity performance was poor. Oh, so I guess I did mean 2004. So there was a 10-year period there where stocks and commodities weren't correlated, which on one hand would, including both in your portfolio, would add to the diversification benefit, but the performance of commodities was poor, so even though it would have helped reduce portfolio risk, it wouldn't have done anything to increase portfolio return. Now the correlation between stocks and commodities is low, but it's greater than zero. So low correlation leads to the risk mitigating impact. That's where the portfolio theory shows that the overall portfolio risk will be lower. However, and positive returns will lead to a return enhancing impact. So if rho is negative, you're effectively deleveraging your portfolio, expecting prior losers. This particular person was expecting prior losing strategies, such as volatility arbitrage, to outperform going forward. I think that's a pretty safe call to say that what's been losing in the past is going to win sometime in the future, but I don't take that with a grain of salt. So what are your choices in alternative assets? Well, options. We can put options, call options. Those are easy to get now, and they may be efficient for portfolios less than 15,000. So we're supposed to. We were advised here to consider using options in our own personal portfolio. This was an interesting comment here. On the way up, as prices are going up, correlation will vary. Some things will go up, some things won't. But on the way down, everything's going to go down. So that's something to be mindful of. And that's where, in the scenario where things are going down, where options may be an efficient approach to mitigate some of your downside in your portfolio. Okay, REITs and commodities may be more correlated to the stock market now than in the past. I'd have to look at some data to confirm that, but I believe it. Uh, let's see, return on capital is higher where capital is scarce. This is an ode to international investing. You want to be the only bank in town. Current expected return estimates are too high. This must be for emerging markets. So if expected returns are too high, they're going to go down. Actually, I'm not sure where this came from. I don't remember. The same person is bearish on emerging markets. This is interesting here. U.S. small cap stocks. One reason to invest in emerging markets is because of growth, right? But he's saying it might be a safer bet to buy small cap stocks to get that growth here in the United States instead of using these emerging markets, which could be risky. I don't remember how this person distinguished between anti-correlated and negatively correlated. There's an interesting assignment for you to go and do on your own and add to the comments of this video. Thank you very much. One person made the comment, Bitcoin is not a currency, possibly a means for transactions. There's been a lot of hoopla about Bitcoin exchanges being hacked and shut down and companies out of business. I think it was the CEO in Singapore of one of these exchanges. She committed suicide. So, proceed with great caution if you're looking at Bitcoin as an alternative asset for your portfolio. One person thinks gold and silver are fairly priced, but natural gas is tougher to value. How do you store it? How do you use it? How do you produce it? Transport is probably another issue. So, natural gas going forward, there's a fair amount of uncertainty there. What are some other alternative asset vehicles? Long, short strategies are making their way into mutual funds. These strategies were before primarily parts of hedge funds, but now they're making their way to mutual funds that you can go buy in your Fidelity account. Then there's this notion of ESG, environmental, social, and corporate governance investing. Are we paying the executives too much? It's becoming more mainstream. There are some funds out there that meet benchmark returns. That's one person's opinion. Another person said they saw mixed results. I would agree with this. I've seen mixed results, but they emphasize, we're trying to make money, not save the world. But would be nice if there were environmentally, socially, and fair paid type corporate governance companies that you could construct an index that would do just as well as your S&P 500. Whether or not that's true today and going forward remains to be seen. One person expects hiring to pick up as clarity on the healthcare plan impact has improved. Companies are uncertain of what healthcare expenses the companies themselves will face as they add employees. So this seems a little bit out of the context of alternative assets, but somebody mentioned it, so I put it here. Be mindful of policy impacts on investing. Again, what does the policy say about pipelines or alternative energy, for example? On using derivatives to protect the downside, this person initially thought your best defense is a well-diversified portfolio. That's kind of the camp I would have been in. But now he's saying, well, maybe you can take a little offense too. So some protection via derivatives may be a good idea. For example, if you think the stock market is going to go down, you could buy a put option that will enable you to sell. A put option on a stock market index that will enable you to sell in the future at a specified price, even if it goes down. But that'll cost you something today. Insurance is not free, so maybe the truth is somewhere in between there. Private equity. Now this I thought was an interesting comment. It says hard to argue that private equity is the right asset class for clients given the liquidity fees and other issues. Private equity, you put your money in there. There may be requirements that it has to remain for 10 years, 5 years, and if you pull it out before then, there's significant penalties, fees. There may be some other issues could be really high risk, maybe little recourse to recover your money in the event of fraud. So this person thinks it's hard to argue that private equity is the right thing to do. Meanwhile, private equity business is still around. So I'll let you decide on whether or not you want to put your millions in private equity. Deutsche Bank is creating products similar to what you can only get through private equity, more liquid. In 2009, not only was it difficult to attract investment in private equity, it was difficult because the market was on quite the downturn. Market and economy was going down quite a bit in 2009, so someone wouldn't want to invest. There's hesitancy to invest in the market in general, let alone illiquid, high-fee, high-risk private equity. So here we are today, 2014. Deutsche Bank is creating products that are mimic what's available in private equity, but more liquid. This guy did not mention the fees for those more liquid products. I would suspect these will amount to being nothing more than some really expensive mutual funds, where you would it may have higher returns, but those returns would be negated by high fees. So VIX, volatility index, is a derivative of a derivative and negatively correlated to the market. Something to keep in mind, but this doesn't tell you anything about leading or lagging indicator, even though it's based on implied volatility of the future. Concerned about fixed income. Rates are going to go up, value portfolios are going to go down. What does this mean here? This could be addressed with a portion of your equity portfolio. That reminds me of some comments from Mr. Yachtman. So let's go over to another presentation of mine real quick. So if we go back to my website, Efficient Minds, seminars at the FAME conference. This gentleman named Donald Yachtman, very successful money manager, made the notion that he views stocks as bonds. He doesn't believe in bonds, just equities plus cash. Let's see here. What do I want to point out here? So essentially, if you pick stocks that have bond-like characteristics, you don't need to buy bonds. I think companies like, say, Coca-Cola, they pay dividends, low fixed assets, high market share, low cyclicality, more bond-like. So this comment from Mr. Yachtman, when was this presentation? This was in November 2013. This presentation was March 2014. There's concern about the impact on the value of bond portfolios going forward, given rising rates. This person's suggesting instead of using bonds, use essentially this is the same suggestion, I believe, as Mr. Yachtman is making here in viewing stocks as bonds. So I guess this person is saying substitute your long-term bond holdings with a Yachtman-like collection of stocks that have bond-like characteristics. Uncertainty equals opportunity. So here we are where market prices are all-time highs, and it's tough for financial managers to advise someone don't invest now. We're at a peak. We're near a peak. However, clients want equity. The firms that these financial managers work for, they want equity, but the advisor knows it's high. So there's a little bit of conflict here that has to be communicated to the clients. I imagine as long as you do a good job of making the client aware of the risks of investing at or near peaks, and if the client so chooses to continue to do that, then it's on them. But I would agree. Don't go all in as a financial advisor, manager, telling your client keep on investing. It will only go up. Tell them it's dollar cost averaging is still a good practice. We are at or near peaks, and you can make a choice to invest or not to invest. There is some potential downside risk. Actually, I think I talked about that in the intro presentation. I have in my DCF analysis here. Part 4, there is value at risk. So it tells you worst case loss in dollars you can expect over a certain time period. So here we are at market at all-time highs. If I were a financial advisor, I would let my client know that, okay, yes, we're at highs, and yes, dollar cost averaging is still a good idea, but here's what you have a 5% chance of losing over the summer, for instance. So just awareness here. Make sure your client's aware. Okay. At the end of this session, the moderator asked for advice from everyone. One person noted that if you try to time the market, on average, you lose 2 to 5% per year. Don't try to time the market. Pretty straightforward. Focus on what things are worth, not what you think others think. I've preached against buying Netflix stock for a long time. It's done nothing but go up. Sooner or later, I guess a while ago, chickens will come home to roost. I think Netflix stocks is going up because of what others think, not necessarily on what it's worth. Again, this question comes up, what can I lose on this trade? Learn how to not lose money. Again, this type of calculation where you can estimate how much you could lose over a given time period. Being mindful of what you can lose was a pervasive theme in this conference, and I encourage you all to be mindful of what you can lose too. One person mentioned the target for the S&P is 1925 this year. See, invest, don't trade. That should be obvious. Ignore the noise. If you can trade your own profit and loss, do it. What this means is don't start your own hedge fund. Don't trade other people's money. Trade your own. And then finally, don't fight the Fed. So I'll let you decide if you want to follow this advice or not. And that concludes the alternative assets. In the next video, we'll look at a few of the other keynote sessions. Thank you for watching.